Ian Simm. I'm the founder and chief executive of Impax Asset Management. And as it says on the slide, I started the business 25 years ago. What we do is provide investment management services to institutional and retail investors around the world with a particular idea. And the idea is that what we call the transition to a more sustainable economy is a great way to make extraordinary investment returns that beat the index. What we mean by the transition to a more sustainable economy essentially is this industrial revolution which is underway in the areas of energy, infrastructure, materials, as well as healthcare, financials, and most other sectors of the economy, driven by the idea that we live on a finite planet, that resource efficiency is going to make money, that there will be an inevitable switch to renewable energy and ultimately to vehicles that don't use fossil fuels, just to give you a couple of examples. So this idea has been playing out for several decades, but is really accelerating. And frankly, it's quite complicated. If anyone has ever, for example, tried to invest in the hydrogen economy, you'll know that it's quite a volatile area to invest in. There are less volatile areas in our remit, but we have a very good track record of making excess returns, and that's attracted clients from all over the world. So today we are managing just shy of $50 billion US on behalf of a couple of hundred institutional investors, and we have one of the world's largest investment teams dedicated to this area. So this is the transition to a more sustainable economy. Essentially what we're doing is using our insights into technology change, regulatory change, changes to consumer demand across the full economic spectrum, and finding companies that are mispriced, that are undervalued, and which are good candidates for portfolios that allow us to beat the market. So this is a really attractive niche for investment managers, and because of this being our sole area of activity, then we stand apart from the crowd, the mainstream asset management space, if you like, and as a result are piquing the interest of major asset owners, from sovereign wealth funds and to major insurance companies, pension funds, and private banks all over the world. So environmental markets is where we started. This is a phrase that Ruth Jenkins-Jones and I coined in the late 90s to really describe, to summarize this idea that there's money to be made from solving environmental problems like climate change or water pollution. And then about 10 years ago, we developed another part of our business, which we call sustainability lens investing, which is not just constrained to solving environmental problems, but this idea of the transition to a more sustainable economy as it affects other areas of the market. So, for example, in this area, we do look at fintech, we do look at personalized medicine, and ways to use smart technology, if you like, to improve the efficiency with which resources are used. It's summarizing our results. So we're now on page 7, which is the results to the end of September 2023. So it says here our assets under management were up just less than 5% over the 12 months to the end of September, and we finished the year at just over £39 billion, just shy of $49 billion. And in that 12-month period, which of course was quite a challenging period for investment management, we've got creditable investment performance. Fixed income capability is really starting to take off. We launched a new office in Tokyo and strengthened our distribution in many parts of the world. And product development in equities was also very strong. We were celebrating our 25th anniversary in July and won a number of investment awards. So the supportive policy drivers around the space, I think, are pretty well rehearsed now. There is, of course, a lot of money going into renewable energy. There's some interesting developments in electric vehicles. It's not a straight line adoption of electric vehicles, as you'll probably have seen from the press in recent days, but that volatility and uncertainty does give us a great bandwidth for investment selection, stock selection. The rally in global equities was dominated by the Magnificent Seven, where we had some but not complete exposure. And there was obviously a big revolution in AI during the year. So this, we believe, heralds quite an interesting period for equity investing, where the play on falling interest rates is now very firmly over, and there's going to be quite an interesting time and beneficial opportunities for active investment managers who are able to exploit the changing drivers and uncertainty around investor sentiment over the next few years. But meanwhile, the progress in China towards electric vehicles, the EU Green Deal, and the unfortunate consequences of weather-related damage from strong winds experienced right now, of course, in the UK, but around the world, floods, storms, droughts, fires arising from changing weather is providing some quite interesting investment opportunities. It's a summary of our assets under management and client base. So you'll recall that I've talked about environmental markets and sustainability lens as the two areas of our equity work. And sustainability lens, more broadly based in orange in this chart on the top left, is picking up as a percentage of the total. But I think perhaps more interesting on the bottom left, you can see the breakdown of our client base by geography. So the UK is just over 20% of our client base, and a crucial feature of the firm is that we are nearly 80% of our client base from outside the UK. Relationships with clients around the world. BNP Paribas represents about a quarter of our business at the moment, and they've been a very solid partner and a strategic investor, also our largest investor with 14% of the shares. We had a very slight negative flows for that 12-month period that I touched on, which relative to most other asset managers operating active strategies was very strong performance. It was a very difficult year for active management. But meanwhile, as it's indicated there, our clients have shown an incredibly high level of confidence in us, 90% positive view of Impax amongst our client base. The next slide, 11, shows our flows for the 12 months in dark blue relative to the previous 12 months in the mid blue. So starting on the left, St James's Place, one of our larger clients, still very nicely positive flows. North America, slightly negative flows, but that reversed quite strongly in November and December. And then on page 12, you can see that BNP Paribas has been actually a source of outflows, given switch of equity funds for many private clients into cash and fixed interest. But meanwhile, in the rest of Europe and in Asia Pacific, we had some very nice client wins and solid performance across other distributed clients. Page 13 is a summary of our business development. So new sales resources in Canada, the Nordics, and a new office in Tokyo, and then distribution partners strengthened in the US, new distribution in Latin America, and more progress with our partner in Australia. Page 14, product development. I think just touching on here the pipeline of new products in equities, and the first bullet point, sustainable infrastructure, social leaders in emerging markets. But expansion about what else we're doing around the world with new fund wrappers, and then our private markets business has been growing very nicely. So that's now been going since 2005. Just a focus in particular on fixed income, where we've been making some quite significant investments recently, hiring some more people. And then a few weeks ago, we announced an acquisition in Denmark of a small corporate credit investment manager who is part of one of our clients, and so is bringing assets under management as well as a team and more distribution capability. So a big focus on fixed income going forward. The Sustainability Centre is the result of a reorganization where we've pulled together our expertise in technology regulation into a single center, which is now able to service both the investment teams and the client service teams around Impax's footprint, which includes offices in the US, Hong Kong, as well as Japan that I've already mentioned. And then in Europe, we've got offices in Dublin, London, and soon to be in Copenhagen. So the Sustainability Centre will be the central point of call, if you like, for our governance work, for our policy work, which we are doing to enhance our investment insights, but also enhance our brand. And then we are doing targeted academic research with investment institutions, again, to sharpen our investment thinking. Page 17 is just a touch on the investment we're putting in the resilience of the company to improve our efficiency and scalability, strengthen our risk function, and improve our governance. And then on page 18, a summary of our headcount. So just over 300 staff now, slight majority in the UK, but with a sizable US team, as I've mentioned. And you can see there the second bullet point that we've had a very strong employee engagement score, third year that's top decile performance, with 97% of our staff stating that they're aligned with Impax's mission, culture, and values. So people right at the heart of our capabilities and future success potential. And then coming to our financial performance on the next page, I think that's page 19. So you can see in the dark blue the most recent 12-month performance, so a very slight increase in revenue on the previous 12 months. Adjusted profit down slightly because that reflected the catch up on the cost base from hires in the back end of the previous year, but also the investments we've been making in areas such as fixed income. So that's led to a very slight drop in run rate operating margin, but we've maintained the dividend subject to shareholder approval at just over 27 pence per share. We are having a chair succession. Our chair, Sally Bridgeland, will step down at the end of her 9 years in the summer of 24, and she'll be replaced by Simon O'Regan, who's shown here at the right-hand side. And we've recruited Sally's successor, and we're in the process of recruiting a successor for Lindsay Martinez, our US-based director, who will also step down after 9 years this coming summer. So just moving to wrap up on page 22, and then hopefully leave a few minutes for Q&A. So what we've been doing for 25 years, for which I think 22 years as a listed company, is to offer sophisticated investors around the world an opportunity to make great investment returns from this industrial revolution which is underway, an industrial revolution which requires insights into technology change, regulatory change, changing market dynamics to be able to spot mispriced opportunities. This is a revolution which is likely to play out for the next couple of decades, and so we've got great runway ahead to continue to ply our trade. And after a couple of decades of work in the institutional market, we do have a fabulous client base all the way from California through to Japan, of some of the world's most sophisticated investors. That does mean that we've got a nicely diversified product base. We've got a very well-rounded and highly motivated team that owns just over 20% of the business. We've got some great distribution partners like BNP Paribas, and we are committed to turning the business operation and business opportunity into ongoing success for our full range of shareholders. So management and BNP Paribas on the one hand, owning a combined 36%, and then 64% owned by small cap managers, and maybe by some of you on the call today. So I'm going to stop there, and sorry that the camera doesn't appear to be working, but I'm going to be listening out for your questions and try and address them over the next 5 to 10 minutes.
Okay, just a nice broad one to start off with. What are the two greatest risks for your business in the next, 3 to 5 years?
Well, I think over the next 3 to 5 years, then we're going to be seeing some interesting developments in our underlying markets. I think the falling cost of renewable energy, batteries, is going to provide some great runway, if you like, for business in those areas to generate great shareholder returns. But at the same time, we are dependent on policy being supportive, for example, to facilitate the permitting of solar farms or the investment of infrastructure to charge electric vehicles. So there are some policy risks out there. I think it's interesting to speculate on a possible Trump administration. Last time Trump was in the presidential office, then our markets actually did pretty well. Trump has made some public statements around, for example, rolling back some or maybe even all of the Inflation Reduction Act, which has been very supportive to many of our companies that we invest in. So I think over that 3 to 5 year time period, we're going to be seeing policy risk as probably the biggest uncertainty. But we do have a very long track record of being able to navigate around that, and generally always found that there's as ways of deploying capital that swerve around specific policy issues.
Next question, you mentioned EV there. Next question is about EV companies. What are your expectations for EV companies? Will they be wiped out by subsidized vehicles from China?
Yeah, it's a very interesting question. So I think the history of auto manufacturing going back several decades is that it's always a game of protectionism and subsidy, as well as falling technology and consumer demand. So there is, I think, a determination in Europe, and I think the UK will almost certainly follow suit, to ensure that the Chinese don't wipe out domestic manufacturing. Germans in particular can't afford to lose hundreds of thousands of jobs in the OEM space as those German Mittelstand companies try to transition. So no, I think our expectation is that Chinese won't be allowed to wipe out European manufacturers. I think the US is a different case in point, where there's almost certainly going to be trade barriers for import of vehicles, but the Chinese will follow the Japanese and the Koreans in setting up domestic manufacturing, which probably will be tolerated, and therefore will provide an interesting sort of policy dilemma for US leaders around the trade-off between profits going overseas and domestic jobs. So yeah, sorry, long answer, but I think this is illustrative of the challenges of investing in this area as a generalist.
Next question is about costs. How do you keep control of costs and headcount?
Well, we've very much designed a scalable business model. So I didn't really point it out, but we have been really plateauing our headcount expansion, and at a time when assets and management have still been ticking up. So there is an inherent scalability in our model from that perspective. The other thing that we do is have a cap on the bonus pots, which is capped at 45% of pre-bonus, pre-tax profits, and we've had that in place for 15 years or so as a limit, and that does mean that shareholders know that there's a sort of minimum level of profit that will go to the bottom line, go to distributable profits. And also, I think crucially, the alignment between the management and team owning 22% of the business and external shareholders is a sort of critical component of our setup that ensures that sort of alignment of interest should carry on into the long term.
I think this quote from me, you on a slide there had a headcount of about 300. Do you know, is there data on how that might compare with peers of a similar AUM level?
It's very hard to make that comparison because it does depend crucially on the business model. So there are one or two long-only managers who've got 3 or 4 strategies and been very successful with large amounts of AUM, maybe $50 billion, but can run that with 100 people. There are others who run private markets-oriented funds who've got less AUM, but twice the number of people. So what we're really focused on is the operating margin, and our operating margin had peaked at around 38, almost 39% a couple of years ago as money rushed in and we were struggling to hire the people to fill out our teams. And as you can see, our run rates dropped now down to 30%. So we're aiming to keep our run rate margin around the sort of 30 to 35% over the next few years. But at the moment, with our business being 95% in listed equities, we do have quite a sensitively arranged business model that is quite geared to equity markets, if you like. Hence the intention to try and rapidly build up our fixed income operation from an established base. We've now got with the new acquisition a couple of $billion in fixed income, and are intending to expand that quite rapidly.
On fixed income, and a few questions come to me on fixed income. Could you explain the basics of what that means, and then what sort of products that enables you to put together and to offer?
Yeah, so fixed income investing, in contrast to equity investing, essentially is investing in the debt that's provided to companies rather than the equity. So with fixed income, then we at the moment are investing in just in credit, which means investing or providing loans or buying debt instruments, if you like, in corporates rather than having loans or debt instruments with with debt securities to link to interest rates. So that credit investing is where we're active. We have at the moment mainstream core bonds fund and a high yield fund. And the business we bought is also in high yield and secondly has an emerging markets debt function as well. So there'll be three things that we do when the acquisition closes in a couple of months. And then looking to the future, there's a possibility potentially getting into private debt. Someone's got a child screaming in the background. We may be getting into private debt, multi-asset credit. Those are the sort of things that we may at some point in the future be able to expand into, but no immediate plans for either of those two right now.
And then, sorry about my children. The next question is about the ambitions for the APAC region, 2 to 4% good growth. Where would you hope that to be, again, in kind of a 3-5 year time frame?
Yeah, so we've made great progress in the Asia Pacific region recently, expanding in Australia, where we've been for 15 years, expanding in Japan, where we've been for 17 years with a big new mandate with a huge pension fund, and building on our Hong Kong investment management team of around 10 people to move from or expand from Asian equity investing to full emerging market investing. So we're very excited about our potential in Asia. As I say, we've been there for well over a decade and have offices now in Hong Kong and Tokyo. And the client base is not particularly well served by groups that have got specialist interest in this area. And yet, as a region, it is particularly exposed to storms, floods, drought. China, Australia, Japan, all suffering from many sort of natural disaster-related problems. So and strong interest in renewable energy as well for reasons that are well rehearsed. So yeah, very excited about Asia Pacific, and it could easily be twice as big on a relative basis.
Okay, Ian, thank you very much indeed. I think we're out of time there. Again, apologies for the connection problems we've had there, and we'll try and get Ian back again very, very soon. So thank you, Ian.
Brilliant. Thanks very much. Enjoy the evening.